I'm gonna kind of frame this, but this kind of coincidentally, this is like a little bit urgent for me because I'm meeting with this client tomorrow. Pete and I have been kind of working through this issue together, and then I was asking if I could have him review my calcs before I go talk to him with JT
Welcome to
tomorrow.
class.
What?
Welcome to class.
Yeah, and then I told Pete, well, why don't we just make this a case study because it's pretty applicable. And honestly, it's kind of funny that this is during the 704C, 704B conversation because that is the crux of this issue. But it kind of conflates, I would say, two complicated problems because I have a 704C issue and then I also have a special allocation of income, which was really why I went to Pete because it was spinning me into the ground. So some of you folks, like especially the Omaha folks, will probably be a little bit aware of this project. This is the Crossroads Mall at 72nd Dodge. It's been kind of a, you know, an odyssey to say the least. And one of our clients, the Lockwood team, is kind of the one of the major developers in the project, alongside a non-client, uh, the Krejci family. So the way that our partnership came together way back when, probably 7, 8 years ago, was Frank Krejci, who's now deceased, which is part of the complicating factor of this whole thing, had purchased the Crossroads Mall at 72nd Dodge for about $8 million, and that was probably 15 years ago. I don't know when it was. And him and Chip, our client, the Lockwood team, decided to say, okay, hey, let's come in a joint venture together. I'll do the sweat equity, you contribute your ground, and we're 50-50. And the way that they pegged it is they said, hey, we'll agree that the ground that Frank is contributing to our partnership is worth $25 million. So 8 million of basis, 25 million of fair market value. Chip, you need to come, or Lockwood, come with $2 million. Okay. And then we're 50-50 in this partnership after we cure the 25-2. So the first 27 million that comes out will go out in that ratio of 25-2. And then we're 50-50 past that. So embedded in that, okay, the other thing that's a little bit complicated that's leading me to have some heartburn here is we said that this first sale that happens, we're not going to take any tax distributions. We're only going to pay debt, which, just big sale dollars makes me a little nervous. So I'm getting pressured in a pretty serious way to try and figure out what the gain is and who gets what. Because now that the one party has died, his estate doesn't care as much. They got a huge step up, but for my taxpayer, it really matters. So, in the vein of Pete's list, the way that I thought about this, really simplistically, is I just took their balance sheet. So I asked for it as of 9/30, and I got it in Excel, and that just so happens to be my book column here. And the client, you'll see, booked these this 25-2, I knew that was a book basis 704B balance sheet because I knew I only had a little over $8 million of basis in this thing when we first started.
One.
Yep.
Where the hell's the losses that you've incurred since inception?
There are no losses. It's all been capitalized in the CIP.
Okay. All right.
Yep.
So, because I thought there were some losses that were taken,
maybe a little bit,
but not much.
Okay. Yeah, we can look at our capital accounts because I also ran the basis schedule up, down, and track it down. But so my balance sheet today is, and it's probably sitting, some of it's sitting here in this remainder speed.
Okay.
So I have cash, AR, $63 million of construction in progress, some AP, a big loan to Pinnacle Bank, his contribution, my contribution, and then some historical retained earnings. So basically, there's still like a, whatchamacallit, like a sign down there that we're collecting some rental income on. Maybe like Verizon has a tower in there. The city was paying rent for a garage, even though no one was using it. Some stuff like that was leading us to have some income over a period of time. So I start there. That's a true book basis balance sheet, 704B balance sheet. With the agreed upon fair market value. I then back off the inherent gain. And for me, I kind of thought about this like Pete described. I know it's a little bit different, but I knew what Frank's tax basis was in the assets he contributed, which was like a pretty strong point of emphasis when this thing came together, 5, 6, 7 years ago, was I knew that was a problem. So I was really hustling Frank's CPA to say, hey, I really need to understand what the basis is so I can get a real balance sheet. Because I knew the bookkeeper that was keeping this or the controller was going to go to book basis, and I needed to never an easier time to figure out what your 704C balance sheet is than at the beginning. I also knew that, chips is cash, and then just to make this easier, I just split the retained earnings 50-50 to make my calc work a little better. And then I work backwards, the debt is the debt, the cash is the cash, the AR is the AR. And I knew then that I must only have 46 million of cost in my my development costs on my balance sheet versus the 63 million that I have on my book side. I know that we're gonna have about 3 closings here over the next 3 years, but I know that the total agreed upon price for the entire ground is 107 million. Uh, I'm saying cash is cash, AR is AR, AP is what it is, debt is what it is. And then I'm getting here by, and I'll show you the calc I did below. I'm getting here by saying, hey, if we liquidated for this 107 million based on our partnership agreement, who gets what? And so, again, I'll get to that calc in a second here. And then I show my gain loss total, which is basically the 107 minus the 46 million of cost. Okay. So I went down and tried to say, okay, where is this cash going to go to try and validate these numbers and these numbers? Because Pete had already caught me where I'd made a pretty big mistake in my 754 calc for not thinking through the waterfall and just assuming we're 50-50. So I was trying to avoid that this time. So I went and said, hey, if I sell this whole thing out, I collect my AR, I already have my cash, I'll get 107,758 of cash get deposited into the bank. I need to go settle debt of 36.8 million. So in theory, after I settle everything, I should have, approximately 71 million left to split. I know that first I do a pref of 25 million because we return capital to Krejci, return 2 million of cash to me. After I do that, there's 43 million left to split, which is just the 70 minus the 27. And so each of us gets half of that, or 21.9 million, which I then just took up here and said, okay, 25 million plus 29, 2 million plus 25 plus the 21 and the 2 million plus the 21. All right, so does that kind of generally make sense, like setting up the balance sheet with a book, an inherent gain, and a 704C? So then I go back and I say, okay, what is this by partner? And I probably am overcooking this, but I like to check things 3 different ways to make sure there's not a miss. And then the ultimate check to me is running through a liquidation on a tax basis in a book basis capital account and seeing if I get to 0. Because if you get to 0, you probably don't have a break. And so I went and said, okay, what's the proceeds that I think by partner? What's everyone's basis? What's the gain? Which is essentially the same thing as this up here, but now I'm just breaking it out on a partner by partner basis. And where it becomes critical for me is I know this is going to happen in, 3 different closings at a minimum. The first of which is happening this year. And knowing that I don't get a tax distribution and I'm going to owe some money, this is where the creative tax professional comes in me to say, okay, what can I manipulate in the gain? Knowing that I'm not the person with the 704C, might I mess with the 704C to push more gain to Frank since he's not a taxpayer and I am? Might I not do my basis pro rata, across the project and act like more of the cost happened on this first lot I'm selling? There's all that type of stuff that I think you need to think about. And again, you can't just make stuff up by any stretch of imagination, but it's not always fair just to assume, okay, the basis happened equally across this entire project, which is, just so everyone knows, that's what I'm doing here to start, just to try to illustrate the concept. So I know I have this amount of proceeds in total. Oh, looks like we lost VDI again. There we go. This 38 is a real number that's coming from the client, so it's not quite a third. There's that, I'm getting slightly more of that. And then I allocated this 47 million I have in total of basis. Oh, come on. I'm allocating that 47 million of basis I have across the 3 sales based on a ratio of the proceeds over total proceeds. Again, to me, this is a number that I want to discuss with the client, because should this, instead of having, a little over a third, instead of having 35% of the basis? Should it have 40% of the basis? Should it have 45% of the basis? Are we selling the most valuable piece of ground first? I think there are all different types of questions we can ask to maybe get to a different tax answer, and I'm not to that point yet. I'm just trying to illustrate. Then I went and I said, okay, I know I have this overall gain in the project by closing of 21.91919. How's that going to go by partner? And I started with saying, hey, Frank's got total inherent gain of 19.6 million or 16.9 million, sorry. And to just make this easy, I said, okay, I got 3 closings. I'm going to bring that 5.6 million in equal each time. And so I said, okay, on this first closing, how's this gain going to flow? And I said, first, I'm going to take 1/3 of my 704C, and then each other piece is 50-50. And you'll see I'm running this a couple different ways, because another way I'm running it is saying, hey, rather than just doing a third, should I allocate my 704C the same way I did my tax basis, which probably honestly makes more sense, but I'm just trying to illustrate to them that we can do this any reasonable way as long as the other side's accountant signs off on it. So I then go through and I say, okay, let's look at the cash, because that's what ultimately matters. And let's, this is what the client's gonna want to see, and then let's compare that to the taxable income calc. So again, I know that I have 107 million total sellout. I know this, I got to pay off this debt. There's 70 million of cash, which ties to what I had up here. And then I know I have a waterfall to do, and then we split 50-50. And I just ran it through closings. And like I said, one of the complexities I have here is the fact that my first sale for 38.8, they're making us pay off all the debt first, which makes no sense to me, but that's what we've agreed to. And then there's only 2 million of cash to go out, which will not eat materially into my waterfall. And then the second sale will happen. We'll finish the waterfall, and there'll be 9.4 million left to split 50-50. And then the last closing, all 35 million will come out 50-50.
Hold on, but what you're doing, you're framing the cash for this piece.
Yep.
Which is complete disconnect
from the gain.
From how the gain's being allocated.
Correct. And so what I'm trying to show my client, who in this case is Royce, is I'm trying to make him aware, because he was like, hey, I just want to pay off this debt. And it shouldn't matter to me because I'm not getting a lot of cash. And I said, you are getting a lot of gain. So don't just agree to paying off all this debt and not doing a tax distribution without us figuring out what this number is, because you're going to owe a lot of tax in April. Which is then when I got Pete involved, because I wasn't comfortable. I hadn't even gotten to even close to this point yet of working out this math. And I needed Pete to just help point me in this direction to make sure I was, kind of considering the issues. So then I say, okay, on a by partner basis, I know that we start with Frank's got to get in total. Let's see, how did I do this? Frank's going to get in total. What the hell was I doing here? Sorry. Okay. This is kind of shittily labeled. I apologize. This is total. Here it is by closing. This should be just a total number. But I'm showing Frank. So he's getting $1.8 million of his preferred in the first close. He's getting the remaining 23 million of cash in the second close. Then he's getting 4.7 of this 50-50 and 17. And if you take all 3 of these cashes he's receiving, it equals his total cash here. And Chip's side, in this first close, he's only getting 145,000 of cash, even though, like we showed up here, his total gain that he's going to get allocated is $8.1 million. So kind of a big tax miss there.
Hold on, say that again, because I kind of fell asleep.
So Chip, in his first sale, he's only going to get 145,000 of cash, because that's the pro rata cash that's coming out. That's the 25-2 ratio of this. Where's that waterfall of this $1.9 million?
Yep.
But I just said up here.
You're doing that proportional 25-2.
Correct.
For 27 total.
Yep.
Proportional 2 divided by 27, and 25 divided by 7.
That's exactly right. Yep. That's exactly how I did that. But what's the issue I'm having here is I got Chip that's going to get a gain. His K1's going to say 8.1 million, but he's only going to get 145,000 of cash because of our choice to pay off all his debt. So the other thing that I think is good, and Brett, you kind of like hit this earlier. Again, coincidentally, one of the things that I started with here, as I was trying to do this kind of calc in my head before I set and put pencil to paper with Pete, was I was like, okay, well, I'm going to underwrite this at 37% Fed and 5% Nebraska, and it goes into that whole, you got to define what property you have. Is this inventory? Is this depreciable? Is it another short-term asset? Is this another asset I plan to hold and sell? And in my mind, I had kept saying aloud again and again and again that this is development property to me, and it felt like I had gotten this ground, subdivided it, done all these things that made me in my head really think it was inventory. And Pete, kind of challenged me to think about it differently and say,
I just thought about it differently.
yeah,
You looked at me. I said, "Well, this is 1231,"
yep,
and you looked at me as if horns had grown out of my head that this was an impossibility.
yep,
Because I did the calc and gave it capital gain treatment with the presumption that there was no 1231
recapture,
unrecaptured 1231, and then you came back and asked the question.
yep.
So, what drove your analysis to say cat or ordinary, and what drove my analysis to say 1231?
So I think of the reason I thought it was ordinary is I normally in my head, when I'm in the real estate developer role, I think of things that I subdivide, improve with the intention to sell as it's pretty blatantly inventory. And so, especially like when we have these folks that are buying raw dirt, subdividing it, improving it, dragging utilities, maybe like negotiating entitlements with the city, it starts to feel a lot like inventory, and I'm selling lots. Uh, which is what just so happened to happen here at the end, but it was not the intention that we went into this project with. And
Well, but it was subdivided. I mean, that didn't happen at the end, right?
no, it happened in the beginning.
Yeah.
Yeah,
The subdivision occurred in the beginning.
yeah,
So everything's still kind of matching your facts
correct.
to lead you to a conclusion of ordinary.
Yep, exactly. And I think the thing that I would tell the folks here is one, this calc took me a fair amount of time to get my head around. It took a fair amount of time, and I don't even know if I would have been able to get through this part and rolling it through the capital accounts if not having talked to Pete first. And not to say you have to talk to Pete, you can talk to Pfeiffer or Canfy or someone else, but on these big calcs,
My
having
preference is Pfeiffer or Campy,
Yeah.
just so you know.
I just go to Pete normally, but I would encourage people to realize, and I mean Hoffman and I pick each other's brains on stuff all the time, or Burton or whoever, but trying to even start a project like this without at least talking to somebody and saying, hey, this is how I'm thinking about it. Tell me I'm crazy, or help me think through what I might be missing, I think is a waste of time, because I wouldn't have been able to get through this without Pete first pointing me in the right direction. Just like, hey, here's how this works with your waterfall and 704C, which was really confusing me. Ian, I don't even think that this is necessarily completely correct. I think this is one way to do it, but I think you could allocate the income in a different way and do it before 704C for the preferences if you wanted to. The other thing
I don't know that I agree with that, but go ahead.
Yeah, and I think the other piece that that helped was, if I hadn't talked to Pete about this, I would have gone way down the road of inventory, which would be a really bad tax answer, and kind of shame on me for not at least thinking 1231.
Because typically you're going into your investor versus dealer rules.
Yep.
And typically when you have a real estate developer, once it's plotted, you're usually, you go directly to a dealer unless there's an exception. And a lot of times developers will take a project and pick out parcels that they're going to keep and build on themselves, and then those can be held as investments for capital gain treatment. But where the IRS typically, where I've read a couple cases that you should typically earmark those out into their own LLCs just to separate it from your normal dealer activity.
And I will say the set of facts here that was really interesting that I think Pete helped me on is, when we did this agreement, it was our intention that us, our client Lockwood and Frank's team, we were going to develop all this ground ourselves, and we were going to own. There's an office building that was supposed to go on this. There was a mall. There was a bunch of apartments and some old folks home. Like there was, a hotel. And our plan was that we were going to contribute all of this property to joint ventures with a hotel developer. For the office building, we were just going to do it ourselves because we know how to do that. For the old folks home, we were maybe going to sell the lot, but we were also maybe going to contribute it and joint venture it. And I think to my point would be that I had kind of already come to what I thought the right conclusion was without trying to think big picture of how did we get here. And Pete was the one that kind of said, hey, I mean, tell me I'm wrong here, but weren't you guys going to own all this stuff? You guys have been talking about this project with me forever. You're going to have this big office building that was going to go down there that you're going to own. You're going to do this, you're going to do that. And then one guy died and everything changed. And that was
kind of goes back to facts and circumstances.
correct.
And which a lot of things when you're dealing with tax scenarios boils down to facts and circumstances on characteristics with especially real estate.
And so to me, that's where I got more comfortable with Pete's position, or our position. But Pete challenged me to this position. I'll sit when
He's
we
going
get
to send
audited.
me. Yes, he's going to put me
I'm
before
gonna
the
go
IRS.
get this.
when
I'm gonna go
consolidate.
get when we get audited. I'll download this video and be like, yeah, see, I said way before it was Pete's position, not mine.
Yeah.
Yeah, it's really JT's
Make sure
position
it's
because he's signed return. Yeah, please record this. But that's where I got very comfortable with Pete's position, and again, kind of having to educate our client who honestly functions in both capacities. He very normally is the developer that is putting up his own buildings and he holds stuff for rental purposes, but he's done a little bit of ground development recently, and I in my head was like, oh, this is exactly like our big land development out at 204th and F Street. And so I just kind of started spinning myself there and not thinking big picture of how did we get to this project and why are we here. So all that to say, to me, the check ultimately, and actually, like I was asking John as I was doing this calc, the check ultimately on this stuff is if I liquidate it, what happens, and if it gets to zero, you can feel pretty correct that you've solved your 704C issue.
When you say get to zero, what the more precise statement is, you start with your beginning capital account, you do your additions and subtractions for your income and losses,
Yep.
and then you compare that ending capital account to the cash that's available for distribution, and that cash available for distribution coming out to the partner should zero out those capital accounts to bring it to zero.
When we liquidate. That's exactly right.
That's what he's saying.
And we can kind of like, I don't want to make this too small, but you can see on this project. So we started with this in 2019. And it existed before that. You can see, like, since the beginning, I've been tracking 704C capital accounts, 704B capital accounts, and then this is not as applicable, but I've been also just tracking cash. Because to me, like, I know that I will probably be the person, very likely, when a close happens, that they say, where are we at in our 25 and 2? Before we start going 50-50. Obviously no one's taking any cash out of this deal yet. But so when I go here and I say, okay, and actually we can just kind of hide this because the names are the same. That might make it a little easier. Okay, so I kind of have been running through this, and obviously, now my tax returns on a tax basis. So this would tie to my M2 each year. This would tie to my balance sheet because my Schedule L is on a book basis. And I've been kind of running it through the end of 2023 here, where I start here, and I say, okay, coming into this year, I had 10,087,000 of 704C basis or inside tax capital, and I had 27,056,000 of true book-based equity in this project on my balance sheet. I asked the CFO of Lockwood to give me a financials through 9/30, sorry. So there was 36 grand of income that I just split between these guys 50-50. That may or may not be right, but it's also kind of wholly immaterial to all this. And then what I did was I went and said, okay, what's going to happen here for my gain on each of these closings? Okay, so like for Chip, you'll see I have this 8.1 million, which is coming from here. For Frank, you'll see he's got a 704C gain of 5.6 and a normal gain of 8.1. So his total should be that 13.7.
So to in the terminology we use today, 5 million is the required allocation,
Yep.
and the 8 million is the agreed upon allocation.
Yep. Yep. So this is what's required to solve our quote unquote, our pregnant gang that we have out there. And this is what we agree to in our partnership agreement. And it's not, obviously, we're 50-50, so it makes sense that these two would be equal with each other. Okay, so you'll see on 704C, I'm shoving Frank more income, okay, versus in our 704B where we're 50-50, our contributions are the same. Or our gain allocations, excuse me, are the same.
And that's because that's the appreciation that occurred post us agreeing to be in the partnership together.
Correct.
And Sam, does the required allocation hit a 704B?
No.
No. Does an agreed upon hit 704B?
Yes.
Yes. Does agreed upon hit 704C?
Yes.
Yes. So then that's what you're seeing here. Agreed upon is hitting both 704B and 704C because he's saying the 8,121,000 is the appreciation that's occurred post the partnership being formed. And our agreed upon allocation is 50-50. So Joe's taking that 8.1 and hitting his agreed upon or fair market value for the 8.1 each, because that's the appreciation that occurred post the partnership coming together. That's the income that's available to split for 704B purposes. But then on 704C, we have agreed upon and required that's going to go in there to equalize the capital accounts as we go.
And I probably would be better off if I, to really hammer that home to these guys, because I will walk through this with them when I do this. Like, I'd probably be better off like having closing one, have two rows to it, and saying, hey,
required and agreed.
Yeah, exactly. Yeah, here's the gain. Here's the pregnant gain releasing. Because required and agreed, they might get confused. But here's the
or inherent gain being released. That's much better for a chip. Yes, 100%.
Exactly. And so then I go and I say, okay, what do I think is going to happen with the cash? Which again I calced back here. Like you'll see. Yeah, so you'll see here, I have 145,000 in cash in the first closing, 6.5, 17.2. And then I have this for Frank. And then I say, okay, what's my net at the end? Which basis probably isn't the right, net basis might not be the right word, but I started here and I said, hey, I had 2 million of tax capital. After picking up all these gains, I'm at 23. I'm going to back off 23 of cash. I'm at $1. For Frank, I had that. I'm backing off this much cash. I have like a $500 miss in here that I have a fat finger in the spreadsheet I haven't found yet.
Okay. Which, who cares?
Exactly. Yep. Not material. And then you'll see here for 704B, it's interesting. It's clearly something in my gain calc or my tax basis, because 704B, I get to exactly 0. And it's clearly the same calc. Everyone's got the same income coming in. I'm solving that by the fact that he's getting a lot more cash, namely 17 million, I think, right? Should be approximately that number.
Yep.
And that's where we're kind of shaking out. So I guess the things that I would want this group to be thinking about as they're getting these is, one, when you have something screwed up or something that's confusing, like I think some of this stuff is very easy for some people, and a lot of it's just probably because of the reps that they've done. Like I think for you guys, pulling together something like this might be more difficult than it is for me, and it's infinitely easier for Pete than it is for me. And I don't start something like this without asking for help with other people. And so don't try and do something like this on your own, and don't even try and start it on your own. Like ask someone for some direction before you really dig in, because I think it'll make the final work product better, and it'll keep you from getting way off the rails before you even start. And the other piece I would tell you is on these bigger projects, challenging people's, having people challenge your assumptions like Pete did for me on this 1231, or I know I've talked to Hoffman a little bit about this project because there's a bunch of TIF dollars at play and other stuff going on too. Just to say, hey, I want to pick your brain on this. This is generally what's going on, and here's my fact pattern. You don't have to put numbers to it, just so someone else can say, well, you're thinking about this wrong. I think is really really helpful and gets the right answer for our clients.
I think
Does it make you a bad practitioner to not know the answer, or to even if you think you know the answer, anytime you get a scenario with some sort of complication to it, and not even this complicated, but you walk through walk through it how you think, if you feel confident, but then I challenge you to go talk to people about it, like Donovan, myself, Pfeiffer, and if Pete's not busy, Pete. But,
I'm never busy.
I think that to Joe's comment though, I think the people that are the best at doing this stuff are the ones that are disciplined to step through every single piece of the transaction and break every, what you think might be one transaction might be five too. So
How long did it take you to learn that?
a long time.
Yeah. Seriously.
Yeah, because your first assumption is to think of the very important pieces and kind of jump to a conclusion, and you'll miss a lot of the stuff in between there that can change the outcome substantially. So the best way to get good at this is remembering the steps that Pete's teaching you here. Here's first step one, what's the basis, what's the value, what's the inherent gain, then what type of asset is it, and the transactions that occur on those assets. Going through every single piece of that is how you get to the right answer. And if you skip just one of them, things can get very off the rails.
And I don't think this is a relatively simple one from the standpoint of we are just talking about one. We're talking about a piece of ground that's going to get sold over 3 different closings.
But the complicating factor is that you have a waterfall.
Then I have a waterfall. Yep, which that was what was really. If I didn't have a waterfall, I would have probably been able to do this without a ton of assistance. But what JP just said, I think is so.
Hold on. So let's stop there. Brett, what the hell's a waterfall?
Was that the 25 and 2?
That is, but
Yeah.
if you're going to describe that to Kelsey, absent this being an example, what is a waterfall?
I would say a waterfall would be unequal cash received by the partners that is not equal to their ownership percentage based on other agreements.
That's a pretty good definition. Okay, so a waterfall is an agreed upon income or loss allocation that disproportionately allocates income in cash in a manner that rewards people, but generally at the end results in some sort of proportional allocation. So there's a disproportional interaction in how income and dollars are allocated in the first steps, with result generally going to be pro rata at the end. And when you say 25 and 2, we have a disproportionate piece of this partnership agreement, which 25 and 2 is not proportional, but reverts to 50-50. Waterfalls are more and more common. And what I wrestle with is, in this case, what Joe's saying is the first closing. Go to your first closing, Joe. There's $21 million of tax gain, correct?
Yep.
Okay. And there's $17 million of inherent gain embedded in all the ground that was contributed. And I've been wrestling with this for a long time. And the more I wrestle with it, I think my conclusion is that, so go to the side, Joe. And let's do a closing. Let's label closing 1704C under E46. You should have been up. Go up one. Yep, right there. So let's do a 704B closing over next to it. So there's a 704B closing that you got to take those same proceeds. Okay. But now the ground at data contribution had $25 million of fair value, did it not? So 25 million of fair value. So go to that next to it, Joe.
Yep.
So no, go over the side and label this basis at formation. And then let's say 25 million divided by 3. Okay. That piece of ground had $8 million of basis at formation, fair value. And then the debt was how much, Joe?
I can't remember. 37 million.
Okay, so let's take that 37 million divided by 3. Add those two together. It should come out to my 22 million. What's it come out to?
21.
Okay, so it wasn't quite precise in terms of his debt.
Yeah, but there's also some AR and some other stuff factored in here.
Okay.
Because this is that back of the envelope is exactly what I did when I was initially trying to do this on like a piece of paper.
Okay, so we have the 704C closing, which is the 8 million divided by 3, the 8 million of basis that he had when it was contributed.
Oh, you know why it's also fucked up, Pete? Because I'm not doing basis pro rata here. I'm not.
Oh, yeah, it's okay. Okay, so the 8 million divided by 3 plus the debt that's been incurred, that's your 704C calc. But going back to what I said earlier, that you have to do a gain loss calc for both for 704B and 704C. And because only required is going to hit which account?
C.
C. But agreed upon is going to hit both.
Both.
Okay, so it's the appreciation that occurs post the formation of the partnership. And if we take the basis, the 25 million divided by 3 plus whatever we've capitalized in that ground should be the basis for 704B calc. And that basis for 704B calc gives us our agreed upon allocation that goes to both people. And the difference between that calc and our 704C calc is going to give us the required allocation that's going to go to a specific partner. So what Joe's done here
And I can
is,
kind of do that by inserting a column up here because I do have a 704B balance sheet, and I can see kind of what this would be on a lot by lot basis.
yeah. So
And even if I just like that's a lot closer here, which kind of makes sense.
well, and it's the disproportionately higher
Basis that I'm
proceeds.
taking this first one.
Well, yeah, and proceeds.
Yep.
So I mean, it's not a third, and a third.
Yep.
So the agreed upon allocation is going to really be driven off of that gain loss calc that's coming on the 704B side.
And the other thing that I keep thinking about with this that has really been causing me a lot of angst is this whole disconnect between
Oh, so yeah, I was sorry. So we have this first closing that is generating $21 million for taxable income. There's $17 million of inherent gain. And if the next two lots sell for 0, shouldn't we push all 17 million of that gain to Frank? Doesn't that feel like that's what we should do? And that's what I've been wrestling with. What is the amount of gain, that 17 million, that I should push to Frank by virtue of this waterfall, this 27 million being allocated, 25 to Frank and 2 to Chip? And my conclusion as I've wrestled with this is I got to respect that 704B gain loss calculation because I got 3 lots, and the fact that I'm selling one of them, I got an inherent gain based net lot. And going back to Sam and I's agreement, a required allocation only goes to C. An agreed upon allocation goes to both. The only way I'm going to get to that agreed upon allocation is by doing that gain loss calc with respect to that specific lot and then dividing it based on agreed upon allocation. And if all of them sold, that works. And the fact that, this is an anxiety causing moment where we have $21 million of gain and the other could just be break even. or they could be a loss. We don't know. We do in this case by
We
virtue.
feel confident.
Yeah, we feel confident in this case, but
I will
having
say it's a really bad answer because, I guarantee you I'm going to get asked that question tomorrow, in that they're going to say, wait, so I'm getting 8 million of gain, he's getting 13 million of the gain, but the cash, I'm getting 145,000, he's getting 1.8 million. And if you take the percentage of the gain,
that's by virtue of them being dumb enough to pay their debt, all the debt.
I know, but still, the percentage of cash I'm getting is a lot lower than the percentage of gain I'm getting overall.
yes,
And I think that's going to be their question to me. I 100% agree. I've been saying all along we should not pay off all the debt. We should leave 20% of it back and use it to pay taxes. But that's not what they want to do.
What's the bank say?
The bank is very happy to get their debt paid off.
Sure they are.
And actually, when we first talked about this, that was exactly my point, Aaron. Was if we want to keep this cash to pay taxes, we got to say it out loud to the bank, and we got to say it now.
Yep. And I think for us, it comes down to there's a lot of complexities here with personal guarantees. One of which is, the guy's dead, and his guarantee's not worth a lot anymore.
How's
obviously,
that work? I wonder. It have to transfer to the
I think
estate.
it's transferred to the trust, to the now irrevocable trust, but the corporate trustee has no interest in being encumbered by this asset. So there's a lot of other stuff at stake that's making, me, the tax person, it's like, hey, by the way, if we just say, even if this guy's not a taxpayer because of the 754 step up, take 8 million times 25%, there's a $2 million tax bill here that we got to pay in April, and we only have 145,000 coming to us. For most people that'd be a problem. We have means to fix it, but that's what's been giving me a bunch of heartache in this situation.
I think what we talked about a little bit when Pete stepped out of the room last time was if your scenario happened to be different and Krejci say, well, we could take on more of this gain because we have loss carry forwards and we don't worry about it. Why wouldn't we allocate, all the gain to them and cure our Sono 4C at that point?
Well, I think you probably get into the argument of does that allocation really have substantial economic effect?
Yeah.
Which I don't think we're talking about substantial economic effect at all in here. Okay, I don't think it's anywhere in the slides. But since the words have now been introduced, we should probably talk about what that means on some level. There is no concept of substantial economic effect in S corps. There is a concept of substantial economic effect in partnerships. And what substantial economic effect means in general is if the partnership makes an allocation of income, the cash sure as hell should follow.
Over a period of time.
The cash should follow. So what Aaron is saying, in substantial economic effect also means that you can't do an allocation of income to game the system. If Joe has a capital loss of $1 million and I have an NOL of $1 million and the partnership that we're in happens to have $1 million of capital gain and happens to have $1 million of ordinary income, and we allocate $1 million of capital gain to Joe and $1 million of ordinary income to me, did we game the system? We sure as hell did. So substantial economic effect really means one of two things from your guys' perspective. The cash has to follow the income allocation, and you can't game rates by your allocation.
Well, I would add another layer of a law. When you get to a loss scenario, your loss allocation should follow either your ownership percentage or who's bearing the risk of that loss, right? If somebody comes in, they don't put anything into a partnership, it loses, you can make a special allocation to somebody that brought all the assets to the table, right? Because if this thing blows up today and goes away, somebody brought all the assets to the table, they really lost, where the other guy didn't lose anything. So, from a loss perspective, it's whose risk of loss.
Either by assets or by guaranteeing debt.
Correct.
That complicates the hell out of what you just said.
It really does.
Substantially.
Goes back to earlier when you said everybody's getting back to zero. Like that's the substantial economic effect. Everybody put something in, got allocated enough to get back to zero at the end of the day when it liquidates.
With cash distribution.
Yes,
Cash attached to what your income allocation is.
yes.
Which, like, again, though, if you think about it, right, like, because of my waterfall, we're taking on a lot of this gain at the beginning, and then we don't really get fixed until 3 years from now when the cash comes out 50-50. You know, and I think this very well might be 27 or 28 by the time it all happens. You know, so it's not like it has to get cured day one. In our situation, it's certainly is not. But you know, I would argue that this clearly has substantial economic effect based on
If we shoved all 17 million of gain to,
I'd be gaming the system.
I don't know that they would respect that allocation.
Yep.
Because I have 3 lots with its own. Those 3 lots have its own 704B basis associated with it, and when we sell that lot, that 704B basis should be compared to that fair market value proceeds, which is going to give us an amount that is allocated based on our agreed upon economics. And that's why I go back to, you can't allocate the 17 million to Frank.
Now, that being said, I know I like to be a little aggressive, and I don't think I necessarily have to do it a third, or pro rata based on proceeds. You know, like, I think if I want to be a little creative here, I'm going to go look at what lots are actually being sold, where we move the dirt to, did one have more utilities, stuff like that, to try and maybe get to a better answer for our client that I feel comfortable, you know, signing a return on.
Okay, so let me restate that just slightly differently. Okay, we have a piece of ground, and the piece of ground has an absolute swamp. It has a piece that has 1 trillion trees on it, and a piece that is pristine and nothing needs to happen. You can just build on it today. Now, are you going to pay more for the pristine one than the swamp? You're going to. Okay, so that $8 million, we could say that one piece was pristine, and more of that $8 million is going to that pristine piece in the acquisition cost, because it all comes down to what was fair value associated with that. The second piece that Joe's talking about is, well, we have $37 million of costs in the ground, and we're going to sell that pristine piece first, and we used 80% to run utilities and everything into that most pristine cost. The next piece to start clearing trees, and a little bit to start pumping out the swamp. Okay, and that's what he's saying. Well, you got 2 levers that you can pull with respect to this basis for fair value. And so, and do we do that?
No, I let the client do it.
He lets the client do it. I have a feeling there might be some guidance.
Oh, help.
Help. That's what we're here for.
Usually on the phone.
All right, any questions? And Pete, you think I'm directionally going the right way for tomorrow?
I do.
That's helpful. I was not feeling great this weekend when I was working through this, so.
No, I think that you should be able to have a nice, productive meeting with Chip.
Yeah.
Tomorrow.
All right.
Nice productive meeting in which he's gonna love the answer.
He's gonna hate the answer. Okay, so there's one thing, and I think the best part of this meeting was something that JP said, because again, how long you been around, JP? 8 years, something?
Like 11.
Okay, 11. Time flies when you're having fun.
Yeah.
And the JP of year 2, year 4, year 5, I don't think understood or appreciated. You have to break something apart and put it back together. And I say it all the time. I have to break something apart into 1 million pieces, and I put it back together. And when it doesn't work, I break it apart again, and I put it back together. And then I break it apart again, and I put it back together. So that call that we had today, how many times did I have to break that apart and put it back together? How many hours do you think I had in that? I mean, 70 to 100. Because when I was talking about, wait a minute, there's the standard, the client gave me a universe of assets. They were 100%. I had 2 partnership interests that I bought part of it, and I had to roll part of it. And there's one partnership I bought 100%, and I have 6 different things all coming in from 6 different directions. And first I had to, Sam, diagnose and understand that the client was giving me a full universe of all the assets in a consolidated schedule. Well, that's a problem because I need to isolate solely on what they're contributing by themselves. So I had to break it apart. And then I had to understand, well, wait a minute. There's a part of these partnerships that are being purchased and part of it that's being rolled. And then I had to break that apart and then put it back together. I mean, this ability to look at something and understand that you can break it down into these small individual pieces and understand that what the pieces are, how to break it apart, and what they mean, and get it to the smallest piece that you can tolerate, and then put it back together, minimizes and eliminates errors. When Joe put something, no, I'm not going to pick on you because I don't think this is as true as I want it to be. Bill Kennedy and Adam Austin. Adam Austin can put something together, and I look at it like, wait a minute, you shortcut the shit out of that. And generally, Adam Austin's hit rate's pretty good at getting to the answer. But I look at it and I say, I have no idea if that's right. Because you skip my pieces. I look at that, I cannot identify if you really thought through that correctly. So what we do is
probably luck, Pete.
What? Luck.
Probably luck.
Oh, fuck, you're on. I'm going to use Bill Kennedy.
He is paying attention.
I'm going to use
wanted to make sure you knew I was here before you go any further.
that fucking asshole, Adam Austin.
I guess he does get credit today.
I will say though, I think that Pete's point though, I think the piece of it too is that he's very patient and doesn't mind. Like I get stressed when I do it the shortcut, and if that thing didn't zero, I would have been way too quick to be like, I surrender. You know, I need someone to help me. And Pete will just keep methodically breaking it down into smaller pieces, making those small pieces get to zero individually before he smashes it back together. I feel like that's the piece to understand. And in this situation, like, you know, I've been with Pete at different times where we've had big transactions, and there I just had B, one asset, C, where Pete will have 20 rows wide or columns wide of, well, this is me adjusting this asset to tax basis because I know exactly what this is. This is me recording transactions costs. This is me booking SARs. This is me doing this. This is me doing that. So that we can like make sure that each separate piece is working and hitting the balance sheet and the P&L, hitting our tax basis schedule. To Pete's point, it makes it so you just don't you'll figure out when you have the error one place because it'll all be working and then it will stop working. You're like, oh, I must have a fat finger in column Q because this was all balancing and all going and my capital accounts are rolling and all these things were happening. And then I did that last entry and it didn't work. And it does take a ton of patience to do that and a lot of confidence in understanding the pieces, which I feel like to me that's what's always intimidating.
I think Joe might be referencing our KPMG experience.
Yeah, or the LRS one, Milan or LRS were both, and I got really sideways on.
This is one of my favorite stories. Is Joe and I, we took a $20 million step up that didn't exist.
Yeah.
No shit. Swear to God, it was 10 or 20.
It was, I think it was a little more. Yeah, it was maybe a little more 20.
And we look at it 2 years later and I go, Joe, we fucked this one up.
Badly. Ian got called on it.
Yeah, 100%. And KPMG was on the other side of it. And KPMG, if you're on the phone with me, if the other side is being cordial, Joe, am I cordial?
Yeah.
If they're not cordial,
Yeah, you can be combative.
I will go out of my way to take them out of their knees if I can. So we were on the call and we were falling on this $20 million sword. Like, yep, we're stupid. I mean, we are stupid. Could we say anything more than we're stupid?
No.
No, we were stupid. And we're on this call and and the whole time, KPMG has been cordial with us. We've agreed to disagree on, and this has to do with non-recourse debt and distributions. So if you guys go back to your basis hurdles, when I talked about distributions coming out of the partnership can be supported by non-recourse debt. You guys remember that? Okay, it comes back to that issue of non-recourse debt supports distributions,
But not losses.
but not losses. So they were taking a position that we didn't have basis for non-recourse. Doesn't matter more than that. Okay, and we were being very cordial. And I basically said to KPMG, look, I have control over the 1040s. I, me and Joe, have control over the 1040s. You have control over the entity stuff. We'll agree to disagree. Statute of limitations runs in a month.
Yeah.
So now we get on a call, and we're on the call, and yep, we're stupid. Joe and I are stupid. Okay, and so, but the KPMG kept picking at a 704 calculation that I did, and they kept picking at a 754 calculation that I did, and at one point during the call, you know, there was an allocation. What was the allocation that they were trying to make? They were doing
So I
something.
think it might have been on the 704C runoff, honestly.
So at some point, the client goes, "What, you guys blessed. KPMG blessed our work 5 years ago. They reviewed our work, and
Yeah, we
now
didn't
they're
file a tax return without them looking at it because I was nervous about the whole transaction.
and now you're coming over the top and you're throwing stones at the work that Lutz did, and you guys reviewed it." And the guy on the phone goes, "Well, that was Lutz or KPMG M&A." And the client just lost. As soon as I heard him say that, Joe and I were off the $20 million hook
Yeah.
because the client just lost his shit. What the fuck? KPMG is like one umbrella, and you're telling me that one hand doesn't know what the other hand is, and it was scorched earth. I don't know if you remember, I just hit mute at that point
Yeah.
on the phone on our side, and I'm like, we're good. We're off the hook.
Yeah.
And I'm actually laughing at this point.
It was funny.
But Joe actually felt bad for this guy on the phone. He got red and he was sweating. And the poor guy, he was just getting blasted.
Yeah.
So since KPMG was cordial, and they seriously 100%, they wanted to work with us. They weren't assholes. I finally went off mute and I said, it was Shakar, right?
Yeah, Shakar, yeah.
I said, look, Shakar, you've extracted your pound of flesh. What you're doing is not productive. KPMG is solving Joe and my fuck up by the way they're doing it. They're not going to go back and highlight in an amended return how stupid he and I are, because they could have.
Yeah, that's what we were talking about. That's what we're negotiating.
And they could have amended the return to highlight how stupid we were. And they were doing it via an accounting method change in the current year to do under allowed and allowable to recapture what we did and take it over a 4-year period. Yeah, over a 4-year period to fix the problem. And based on them being cordial and them taking us off the hook, I said, this is not productive. They KPMG have been your complete advocate through this whole process. They're trying to do the right thing, and the fact the guy said something stupid, you should just let it go. And Abe goes, or Shakar goes, okay, and everything worked. But that was,
What if that would have been Kim Suka?
I would have fucking taken her out of the knees.
And I will say on that deal, because they're still like a pretty big customer of mine, and I'm very close with these two founders. And even that $20 million, I was very nervous about, because it was a really big mistake.
It was stupid.
Even in the scheme of a $270 million transaction was still materially not good. But because I'm so close with these guys and I've helped them through a lot of things, and they know that they put me in a bad position sometimes with rushing me, and I always disclaim everything and say, well, this is what we're doing, but you're not really giving us what we need, or hey, I really want KPMG to bless us. Nah, I don't need to do that. Like, I feel like they would have let us off the hook, because also I wasn't going to try and talk my way out of it. I was just going to be like, look, yeah, you can see where we were working at midnight in June trying to figure this out because the closing was happening, and we have an error here. And it was literally, I think it was that plainly stated.
Yeah, and actually, when they did the initial the financing with warrants,
Yeah. which we got out of that too, because I told him, I'm like, you're not even giving me time to look at this. I'm just going to follow whatever you tell me.
We had a call with them and we said, we don't know what we're doing. You know, there's how many answers are there, Kelsey?
A lot. 3,
Two.
2.
The answer, and I don't know.
Yep.
We were on the phone and we said, we have no idea what we're sitting on here. We're not warrants people. We don't know what we're sitting on. We don't know how all this works. And they said the other people gave us guidance. All right, fine. We're going to accept you got guidance from somebody that knows something more than us. Well, that guidance wasn't very good. And
I don't even think they got guidance. I think they just told us what they wanted to have happen. We said,
that's
sure.
my story. That's my story, and I'm sticking to it.
Yeah.
But
And actually, it's 22 million now because I remember exactly what happened. That was what happened was we had penny warrants that they said just ignore these, and basically they went and got a 22
oh,
million
they were a
loan.
partner.
Yeah,
Okay.
and because the warrants were so in the money, these guys were a partner in the partnership that Pete and I didn't even realize they should have been a partner. And because they had lent the $22 million to the partnership, clearly they had at risk basis, and we'd given Abe and Shakar non-recourse debt basis for that 22 million and distributed out all the cash.
Yeah.
And so we had a $22 million.
Yeah, I'm gonna have
tax
nightmares
basis.
again tonight.
Yeah.
So, but to their credit, when we said, you said that you knew what was going on, and we said we didn't, they go, yep, that's what we said.
And I will say it was kind of funny because when this originally came out in due diligence, I was on the phone without Pete, and it was probably like 10 p.m. in June with some attorney in New York talking through this. And she's like, hey, in due diligence, it looks like you guys missed adding this whatever venture debt bank as a partner. And I'm like, yeah, I guess that's right. You know, didn't think of that. Like I was told that they weren't a partner. And she goes, well, so we need to do that. And I'm like, well, I think that's going to create a problem for me. And she's like, well, what do you mean? I'm like, well, we distribute all the cash. And this lady's like, oh shit, that's going to be a big problem. And Abe and Shakar, the two guys that owned this business at that time, were on the phone too. And afterwards I called them like, they're like, well, what does that mean? I'm like, well, it means each of you have an $11 million capital gain report. And I was like, we can decide if we want to amend or not amend. We chose not to. And then we just picked it up at the end. But it was very stressful.
Yeah, it was all fun. All right, looks like it's time. I don't know. I got 5 minutes more worth of blathering in me. So it's time for you guys to go drink beer and do whatever it is that you're going to do.
I'll add one last comment just to bring it all full circle and kind of in support of the things that Pete beats into our heads over and over and over is
Kindly.
depends. Is the temptation as a lot of this stuff comes up, like with Joe's project here, a phone call of, hey, we're selling this property. I'm not getting much cash. We're going to pay down debt, you know, end call, right? And the temptations to go along with that and oversimplify it and shortcut to the answer. And if you don't break it down, like Pete says, in all these different pieces, you're going to miss the fact that he's got $8 million of income, no cash, and has to pay tax. Not to mention, is that a big problem that needs to be discussed? But you also potentially forego a bunch of work that Joe just did. That's very valuable work that we bill our clients for too.
That's the most valuable thing that was said all day right there.
So
It'll
there,
make us money.
there's a lot to be said about, you know, asking questions, giving, you know, maybe even giving in them an assumption, but with a qualifier of, here's what I think, let me dig into it and I'll come back to you. So that's not only a warning of, I don't know if this is correct, but also a warning of, hey, you're also going to get a bill for this.
And I
Both
think
things
it's
are good.
comical because I met with them 3 weeks ago and did that calc on one sheet of paper, and I told them I thought the game was $7.5 million, which ended up being very close to correct. And past me would have probably left it at that and said, "Yeah, scam that, put it on the G drive. I'm sure that's probably pretty close." And I've been burned enough times where I've had a really critical mistake and have then had to go try and fix something with P at the end, or had to call someone in March and say, hey, I thought this, but I didn't understand this, and this was happening. And so now I am like, I'm still pretty confident in what I know, but I'm like always very willing to give people the answer in the meeting and say, hey, by the way, this could be way, 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 way wrong. And the client over this last 2 weeks has taken me to do this because I've had some other stuff going on. He's been like, well, yeah, so it's $7.5 million. So this, I'm like, no. We think it's $7.5 million. It could be, that is a assumption that's yet to be confirmed. And he keeps saying it, oh, we're doing this, $7.5 million, we're in an opportunity zone. We think, we don't know. And he's getting annoyed with me, and to the point where I'm like, look, just stop saying 7.5 million. Like, that was referenced. I did that calc in 3 minutes sitting with you at breakfast. Like, that's not you can't take that as gospel.
And the client's a lot more willing to pay a tax planning bill from us as they're going through the transaction than in April, right after we filed their tax return and sprung a surprise on them that cost them millions of dollars too.
Adam Austin.
Yes, sir.
Do you want to talk about the steaming pile of shit left in the corner?
No. Yeah, I can. I mean, what? That was
This is dead on JP's point.
I inherited a client from Dana that I don't remember the timing of all this, but I'm kind of trying to remember here. Did Dana leave in maybe August, and we sat down and here's half a dozen or so clients that you're going to inherit from me. Here's what you need to know. These people, it was a vet practice. They sold to one of these vet aggregating groups, roll up private equity thing. And I've done all the gain calculations on it. It's all out there. You know, here's my spreadsheet.
And this is what Dana says.
This is what Dana had told me. And so it gets to be, you know, this time of year, I think it was probably early December or so, I contact these people and say, all right, year-end planning, let's get going on this stuff. And I can't remember. Oh, it was, there were some, you know, I'm reviewing some of these calculations that Dana had done, and there were a few pieces of it that I was kind of unsure about, and so I ended up just calling Dana to see if she would walk me through parts of it. And it ended up that because of the way the deal was structured to allow that, they did the old Freilicher special where they sell for a note, distribute the note out to the shareholders, and then the shareholders are the ones that actually collect the cash on that note. The entity was supposed to have been liquidated as of like March or something like that. Isn't that right, Pete?
Something, yeah.
Essentially, at the time that we realized what was going on here, we already had tax returns that were 6 or 7 months late, and it was a huge mess.
And the work was not substantially done.
And the work was not done. Yeah, it was sounds like maybe Joe, whatever situation you were talking about there, where it was back of the napkin, done on a 1-sheet Excel spreadsheet, that it was not scientific whatsoever. So we ended up having a meeting with these people to say, you know, there was a little bit of a dropping of the ball and the changing of the guard here, and we've got a problem on our hands, and you can expect to receive notices for late filed returns and so on and so forth. But we think it's more important to respect the timing of the transaction to make sure that you still qualify for the Nebraska cap gain exclusion, rather than losing that benefit to save on a couple $1,000s of late filing penalties, which we think can be forgiven anyway. And they were more or less fine with that. I'm sure they were irritated from the outset, but I don't remember where things went from there.
Well, it was the bill at the end.
Yeah, it was the bill at the end was definitely what set them off. I mean, we kind of came to this realization in December, January, and pretty soon it's busy season and the thing's already late. And I think we ended up getting the business returns actually filed shortly after busy season in like May. I think it might have been May or early June. And then we do their personal return and so on and so forth. But then to JP's point, we end up sending them a bill for, I don't even know how much it was.
30-40 grand.
$30,000-$40,000. I mean, in the scheme of things, not a humongous bill, but just enough that it pretty severely pissed them off to say
they didn't take it gracefully.
No, they didn't care for that. And they're a Lutz Financial client, and you know, we stood to lose. They walked away with quite a bit of cash after this thing, and we stood to lose a accounting firm client that from here on is going to be a pretty small CPA client, but a pretty big number in Lutz Financial's world, and they were pretty pissed off that Lutz made a mistake. To this day, I don't feel like we were sort of on the receiving end of the mistake, but Lutz made the mistake and then sent them a bill for $40,000 a couple months later for having to clean up the mistake that we had made, which was work that needed to be done anyway. They were just under the perception that the work had already been performed, and the whole thing was just a shit show. And yeah, is that enough detail for you, Pete, or do I have to keep
That's
reliving this publicly?
And here's what I would tell you, and Adam, you can confirm, deny, and trash me as much as you want. But when you came to the firm, your ability to execute on a transaction, walk through the individual pieces was not very good. And you've gone through 6, 7, 8, 9, 10, 12 transactions, and your ability to execute on that, to break it down to the individual pieces and pull it apart and put it back together is infinitely better. Is that correct?
Yeah, 100% agree. I mean, my experience at the place I came from, I was not doing this kind of stuff. I just did not have experience in this arena. And so the very first time I remember walking through this with you, Pete, and a couple others, he who shall not be named, it was like, what the hell are we doing here? You know, you understand the general concepts of it, but a lot of it was pretty Greek to you. Having gone through several iterations of it now, and you almost kind of want the opportunity to do it yourself. You know, ideally these things hit outside of busy season, and when you have the opportunity to take it all apart and put it back together in the June, July timeframe, you know, these are getting real world examples where you can identify the issues, attempt to diagnose them yourself, and work with Pete for confirmation on those things. Is honestly kind of fun projects to do these days. And, you know, each one you get a little bit better and better in sniffing out the issues.
Well, we had one where there were two entities part of a transaction. One sold everything and the other one didn't sell anything, but the one that didn't sell anything had some closing costs and some other things. And why in the hell does a non-seller have closing costs? And he and I went back and forth on that in the conference room. And to his credit, he had me stumped a couple times as to how we should manage this. And the fact that the logic trees that he was using were really good logic trees. And he had me stumped a couple times, but I think I won. I think what I said was
Okay.
So anyway, that's enough plug for Asshole Austin.
Thanks, sir.
All right.
That was great. Thank you, Pete.
Yep.